started. So welcome and thank you guys for joining us this morning. Today we'll be featuring a leadership webinar that will cover the current state of the apartment industry. Our education team has put together several webinars for you and your teams during the month of June and July. Our next session will take place later this afternoon at 2 o'clock at Town Hall, and it's our Latte with the Lawyer. This is a free webinar and you can register to attend on our AMA website. I would like to take the time to remind you that during this challenging time, our vendor members are there for you. They are ready to work with you on whatever budgeting restrictions you may have or emergency services that you may need. They have been your trusted suppliers and would like to continue to provide you excellent service at any time. A few of them are identified on the slide and live by the motto AMA members supporting members. We'll now turn it over to Courtney Levinas.
All right, good morning, everybody, and thanks again for joining us. We're really excited this Friday morning to present a great lineup. So we'll hear a little bit from Mark Dwayne about the financial markets, and then Natalie Evans on the rental housing markets, and then finally talking with Chapin Bell and Mike Cloud, two of our Arizona nationwide industry leaders, to talk about how they're kind of operating and managing through the COVID pandemic. We will have a question and answer period available at the very end after each of the speakers and panelists have talked. And so if you have questions, though, as we're moving through this, go ahead and enter your questions in the chat box. And at the very end, I'll try to help facilitate the questions and we'll go from there. So each speaker will have about 10 to 15 minutes or so. And that will leave us plenty of time at the end for your burning questions. So with that, we're actually going to start off with Mark Dwayne. And just to give you a little bit of background, if you haven't seen Mark at one of our PNP events, he's back by popular demand and always popular at our PNP events. But he has been a financial advisor for 28 years, starting his career in 1985 at Payne Webber. He's been in Arizona and Phoenix since 1970. And he joined RBC Wealth Management in 2009. An ASU grad, you'll notice on the screen, we got a couple ASU grads. And but prior to that, he worked in construction management, architecture, and service professions. While at Payne Webber, he completed the requisite training for the Equity Institute. So with that, Mark, we'll turn it over to you. And thanks again for taking time today.
It's my pleasure. I never thought that I'd be talking about the economy in such a challenging time. I don't think anybody could have anticipated this, and it's very challenging for everybody who's in charge of anything these days to do even some simple financial forecasting or planning. But I'll try and give you some perspective. I don't have any slides today. I wanted to really just have your attention and talk with you, straightforward, so you weren't distracted by that. Basically, we're in a situation, and I wrote a piece which I'm happy to forward out to the association, which can be sent out to you. I wrote a piece right after this started about what I thought was going to happen, and it's panned out fairly accurately. Predicting is obviously very, very difficult, but we were in a situation where when COVID hit, we lopped off a very significant chunk of the gross domestic product very abruptly. So GDP in dollars is about $20 trillion. And I'm going to give you some things so those aren't just nebulous numbers. So GDP is about $20 trillion annually, plus or minus. We were on track to have that grow by about 4% this year until COVID hit. And basically what the virus did is it stopped basically all voluntary commerce. So travel, which affected air, hotel, dining, both locally and those people that are traveling, casinos, gambling, that whole arena, and a lot of discretionary spending. And then on top of it, it made it very difficult for people to forecast. So without the ability to forecast, what are you going to do? You're going to postpone making capital expenditures. And so that happened very abruptly. And so with a $20 trillion GDP, you lopped off probably in the neighborhood of 20% of that. By the time this is all said and done, probably $4 to $5 trillion worth of GDP that just didn't occur. Coupled with that, the government stepped in and realized that because those people weren't spending that money, and gross domestic product, again, for a definition, is the value of all goods and services produced in the country by everybody on an annual basis. So we lopped off for $4.5–5 trillion. And then on top of that, what the government did is it printed money, unsubstantiated printing of money to the tune of $4 to $5 trillion. So that gives you a cumulative there of about $10 trillion that worked against us. If we all pay our taxes every year, corporations and individuals, we contribute to the federal government about $4 trillion in taxes. So you've got the income tax piece that's still coming in, but that's going to be smaller this year because of the fact that a lot of commerce didn't take place. And then we issued $4 trillion in stimulus, $4 to $5 trillion. By the time it's done, it'll probably be $7 or $8 or $9 trillion. And then we had lost GDP of $4 to $5 trillion. That's a lot of money. What happens then is sometime during the next 12 to 24 months, as they reconcile the books, which is going to be extremely difficult, they're going to transfer that operating deficit over to the balance sheet. The balance sheet, we're sitting with about $23 trillion, and now you're going to push it probably close to $30 trillion by the time this is done, call it 12 to 24 months from now. And when I say this is done, I'm just talking about the reconciliation. I am not talking about the virus itself. And so you look at the impacted industries, which are really hotel and air, domestic and international travel, casinos and restaurants. And I know in Arizona, in the last 90 days, we lost almost $1 billion in restaurant revenue. That's coming from the Arizona Restaurant Association, from Steve Chukri. When I saw him 2 weeks ago, the number was sitting at about 850 million. So we're just under $1 billion from there. Now, let's talk about some positives. The country has still got 340 million people, and those people still need to live somewhere. Because of COVID and the challenges that are being faced from an employment standpoint, somewhere around 20 to 25 million people unemployed over the last 90 days. Those people are not going to be home buyers. They're going to be renters, number one. Number two, certain states have been particularly hit hard that are geographically located relative to Arizona, one of them being California. Right now, we've got somewhere around 275 people from Arizona moving from California to Arizona every day. A lot of those people, for the time being, at least a foreseeable couple of years, are going to be renters. Number two, the rents that are in California are much more substantive than they are in Arizona. And so those renters coming from California to Arizona are going to look at our rents and not think they're high at all, which is going to allow the apartment owners, builders, and managers to have the rents you have now and potential increases moving forward. You're also going to see a situation where some of the lower end people may actually move up to higher quality properties because they've abandoned the idea of buying that first house. So you're going to see some of that taking place. Now, you've got an interesting dynamic here, and the message hasn't been fully conveyed as to what's going on, and I'll give you a little snippet because I am involved in healthcare as the chairman of Valleywise, which is the county hospital and the only public hospital in the state of Arizona. We have just statistics for you to digest the news. We have 1,500 ICU beds in the state of Arizona. That's all hospitals in the state. We've got about 16,500 hospital beds in Arizona all hospitals. The number they keep throwing around that we're at capacity in the hospitals is not that we've got capacity in the general acute care setting, the general hospital bed. Where we're starting to bump into capacity is the intensive care unit bed, that 1,500 number. Now we are set up, and we did this about 3 months ago. We did set up a backup reserve. We've got approximately another 1,500 beds, all hospitals in the state of Arizona, set up so we could handle up to about 3,000 people in intensive care. And if you think about this virus, what's going on is by the time somebody comes to the hospital, they need significant care and they need the intensive care bed. And so they're not going into the regular room, they're going into the ICU bed. So when you hear these numbers, it's important to give some perspective so that you understand the capacity issue is on the ICU side from that standpoint. That's just a little snippet of that particular piece. The one area that I've got some concern about, and it's only going to show us the answer over the next 6 to 12 months, is what's going to happen with commercial real estate. Most publicly traded big corporations, 50 to 100,000 employees, mine included, have sent out a survey asking us, how do you like working from home? They're finding out that a lot of people are very efficient working from home. And then there's those people like myself who need that structure and need to be away from the house to feel most efficient. So it breaks into two groups. I'm in the minority in the fact that I like to go into the office and participate in all of that stuff. A lot of people are very comfortable working from home. So the survey is asking, how do you like working from home? And they're going to make some long-term commercial real estate decisions over the next 6 to 12 months as to how much commercial real estate do we actually need. So that would tell you that there should be a reduction or could be a reduction in the amount of square footage and office space that everybody needs. That does not portray a very good picture for those people that are running a big building. They're trying to get 40 or 50 bucks a square foot for commercial real estate, in the 24th Street corridor, the Central corridor, or down by the Capitol, those types of things, or the Scottsdale real estate, which is even more expensive. However, COVID-19 is going to mandate something different. And I'll walk you through. We just spent about $1 million remodeling my office. The cubes, the area where a lot of people work, got smaller and they got closer together. We've already seen a corporate mandate come out that the cubes have to be larger and farther apart. And so what that means is you could absorb the excess real estate that people choose not to occupy because they want to work at home. You could absorb that because of the fact that I think personally, this is going to bring back individual offices with doors. And it's also going to mean that if you've got cubicles, that the walls are higher, they're further apart, and they occupy more space. So the two of those could actually work in conjunction with each other and offset each other, so there's not this glut of commercial real estate out there. But that is one area where I do have concerns. From your standpoint, the reason you're watching this is because you own, manage, and operate and build apartments out there in this world. The demand isn't going anywhere. People are going to need that space. And what it's also going to do is cause you all to be inventive about the amenities that you provide and the way that you take care of the property and the cleanliness with which you take care of that property, so that as a tenant, my place works properly. I've got a convenient place to go. Maybe it's a gym, maybe it's a common area, maybe it's an entertainment area within the apartment complex, but those are going to have to be cleaner, and that's going to be by demand. COVID, as the governor stated yesterday, is not going away anytime soon. And I get briefed on a daily basis, actually, because of my involvement with the hospital, on what's going on with this virus. And until we reach a critical mass where this virus has been transferred from individual to individual on a number of occasions where it can actually get herd immunity, we're not going to see it slow down anytime quickly. And if we keep having these kind of head fakes or false starts where we say, let's open up, and people go out and they abuse it and they act in mass, then you're going to see the spike. And right now, 20 to 40-year-olds are the highest number that's showing up. You're also finding in the rural areas a lot of pushback from wearing of masks. And so right now it's voluntary by state and it's voluntary by city as to whether or not the mask is something that's going to force that. But from an economic standpoint, GDP, the economy and the stock market have been amazingly resilient. The stock market has surprised me. It just shows you there's pent-up demand, and that once we get a sense of normalcy, the economy is going to come back, because at the end of the day, everybody is getting up and going to work, and we will reabsorb and retool those individuals that have been displaced. And we're also going to have to reconfigure the dining situation, and people are also finding that takeout works pretty well. Home delivery works pretty well. We've got some kinks and some growing pains we're going to go through, but we will get through this. The federal debt issue that I talked about, the $30 trillion, isn't going away anytime soon, and it's probably not going to get addressed maybe even in my lifetime. The number will continue to get bigger and bigger unless they come up with some program, and on the horizon right now, I just don't see it. So
all right.
I'll conclude.
Oh, okay. Thanks, Mark. And again, if you have questions for Mark or any of our panelists, just be sure to put your questions in the chat box and we'll get to them at the end. So we just want to be sure to save a little bit of time at the very end for some questions. But next we've got Natalie Evans with CoStar and Apartments.com. She has been in the multifamily industry for 16 years, and she's worked in almost all positions in operations, including management and systems analysis. Natalie's been with CoStar Apartments.com for 4 years and covers Southern Arizona and New Mexico markets. She is an AMA board member and very active in the association, an Arizona native. Natalie enjoys spending her time with her 5 dogs and 1 cat. You have a busy house. I thought mine was busy with 1 of each, but 5 dogs. You got a lot going on, Natalie. All right, with that, we'll turn it over to you to hear about the rental housing market.
Perfect. Thanks, Courtney. And then may I have presentation controls, please?
Natalie, on the very bottom, it says share your screen. You can share your screen that way.
Yeah, all right. Sorry, guys. I'm also not super familiar with Zoom. We use other internal programs. All right. Hey, there we are.
Oh,
perfect. All right, guys. Thanks for your patience there. So, Courtney, thank you for that lovely introduction. What I'm bringing to you all today is just an update on the Arizona multifamily market conditions. My name is Natalie. I work with the CoStar Group in the Apartments.com division. Many of you probably know my colleagues throughout the state. I will be talking today about both Tucson and Phoenix markets, touching on vacancy, rent growth, and just some impacts that we've seen due to COVID-19. Now, in Tucson overall, we started the year positively, and thanks to steady employment and population growth, we had a very high demand for our housing here in the Tucson market. However, with the onset and the outbreak of coronavirus, we are expecting an impact in the near term, and we're already starting to see the effects of that in both, rents, concession, and vacancy. Tucson vacancies, while they've significantly improved since the last recession, due to job cuts and furloughs and just a weakened economy overall, we do expect to see a weakened demand over the next few quarters. However, at the same time, our construction pipeline is robust, and a majority of those units are expected to be delivered in 2021, which will help soften the impact of the weak demand over the next few quarters due to COVID-19. You'll see here that what we're seeing is, since people are having to consolidate finances in households, we are seeing a lower I'm so sorry, Courtney. I have a display issue. Can Courtney or Michelle tell me how to get rid of there it is. Okay, thank you. Couldn't get rid of the faces at the bottom of my screen. It is covering up my legend. What we're seeing is an uptick, a slow uptick in vacancy that we expect will not peak until towards the end of the year. So even with that said, vacancy rates have been compressed and remain right around 6.4% in the Tucson market. With regards to rent growth, we've certainly enjoyed steady rent growth in the Tucson market. In addition to growing job opportunities pre-COVID, one of Tucson's main draws for population overall was the low cost of housing. Before the pandemic, the combination of strong in-migration and the minimal supply contributed to having vacancies near record lows. Those type vacancies allowed landlords to achieve consistent rent growth quarter over quarter. And those gains were already decelerating from the peak that we had achieved in 2019, quarter one 2019. Our submarkets in the foothills and northwest part of the city, including Oro Valley, Casa Adobe, and the east side Tucson, have enjoyed some of the higher percentages of rent growth since about Q1 2019 Per bedroom, you can see that there is not a single layout that was immune to those rent increases. All floor plans at a pretty steady pace have enjoyed steady rent increases looking at the same time period, and especially coming out of the last recession. Tucson construction overall, like I said, we have about 8 projects under construction here, and that's going to total about 1,200 units, more or less, equating to about 1.5% of the inventory overall in Tucson. Average size of these communities will be about 159 units. And although coronavirus is definitely having an impact on both the construction timelines and the development, with those projects slated to be delivered in 2021, we expect those to be absorbed pretty nicely here in the Tucson market. Transitioning over to the Phoenix market, overall before the coronavirus, Phoenix was an extremely solid market, supported by some of the strongest employment and household growth throughout the country. That, coupled with relatively low level of single-family home building and health demand, kept vacancies relatively tight in Phoenix at approximately 6.8% overall. Regulations that were put in place to stop coronavirus resulted in record low jobless claims, and record high jobless claims, as we all know, which has created a drag on the economy there. So despite a healthy first quarter, leasing volume has definitely substantially slowed since mid-March, and construction activity is still continuing on with a hefty supply line. Demand drivers in Phoenix that were supporting market metrics before the pandemic will continue once the effects of the virus fade. And Phoenix is likely to remain one of the fastest growing metros in the country. However, single family development has been slow by historical standards. In terms of vacancy, again, strong employment growth and the household formation were stimulating the apartment demand in Phoenix. The shock that the coronavirus placed on the market will definitely lead to a rising level of continued unemployment claims, and net absorption is expected to fall negative this year for the first time since 2007. However, we do expect the impact to be temporary, and the market is expected to eventually return to normal market conditions. Pent-up demand and the market's sustainable growth drivers will support the multifamily sector in the long run. Phoenix was a top market in the country for multifamily rent growth for the second consecutive year in 2019. Again, steady gains were supported by the employment growth and household formation and moderate new residential supply. Before the pandemic, the annual rent growth was already tapering, with rent gains decelerating from a high of 8.2 in Q1 of 2019 to about 4.1 in Q1 of 2020. Some submarkets have achieved stronger rent growth than others, with the robust household formation and relatively limited supply early in the expansion, generating substantial rent growth in the East and West Valley markets. With regards to construction in the Phoenix market, there are currently approximately 61 projects that are underway. This estimated total equates to about 15,800 units, or 4.8% of the overall inventory for the market. Following 2 years of heightened new supply, development will definitely remain elevated through 2021, and construction has continued since the building trades were designed as an essential service during the statewide stay-at-home order. Some timelines were delayed due to supply chain distributions and interruption in those deliveries. Though for the most part, it was business as usual. And that brings me to the end. Those are some quick highlights that I was happy to share from you from each of the submarkets, or each of the markets rather. However, of course, there are, you may have tons more questions and plenty more details specific to a market that you're working in, and that's okay. I invite you to reach out to me. I'm happy to put you in touch with your local market expert and get you all the information that you may need. So thank you for your time today, and thanks for having me, Courtney.
Great, thanks Natalie, great update. And again, if you've got any questions for Natalie or for Mark, go ahead and put them. I think I said earlier to put them in the chat box, but we have a special Q&A box, so you can put them in the Q&A box. So next up, we're gonna have just a kind of an informal panel with Chapin Bell and Mike Clow, but first I'd like to introduce both of them. I'm sure many of you on the webinar already know them, but Chapin Bell is the CEO of PB Bell, and he leads the strategic planning, growth of the company, and oversees all aspects of PBL, including development, acquisitions, and property management. After serving as a commercial lending officer and vice president for National City Bank, Chapin joined PB Bell in 1993 and worked alongside his father, Philip Bell, for 25 years. Over the years, Chapin has developed more than 4,000 units and acquired over 3,000 units. Chapin now serves on the board of directors for the Real Estate Investment Advisory Council and Valley Partnership. He's a member of the National Multifamily Housing Council and UMOM's Patrons Committee, and of course, a former chair of the Arizona Multi-Housing Association. Thanks, Chapin. And Mike Clow is the executive director and leads Greystar's third-party property management portfolio. Mike maintains management oversight of third-party operations in all U.S. regions and oversees the company's client services team, which provides support services to all U.S. property management clients. Mike has been an active leader in the multifamily industry since 1989. Before joining Greystar in 2008, Mike was principal with Gray Clow Residential, where he developed, managed, and sold over 7,500 units. Before that, he was the division vice president of BRE Properties, a broker with CBRE, and regional manager with Evans Withicombe. Mike is the immediate past chair of NAA and also a former chair of Arizona Multi-Housing Association. So welcome both of you.
Thanks, Courtney.
Thank you, Courtney.
Thanks again for being with us. So I've just got a few questions. We'll keep this just really informal, but I know our audience would like to hear a little bit about how you guys are managing your companies through the craziness of the coronavirus pandemic. So we all know that COVID has really turned our industry upside down over these last few months. But maybe you guys can, and Chapin, we'll start with you. Maybe you can take a few minutes and talk about when you expect the industry to kind of return to normal, or what that new normal might look like.
Sure. I mean, first comment, I know Mark made some observations about how this changed what we're doing. I never thought I would be on a panel in my cargo shorts and slippers, but that's happening today. So, but yeah, no, as far as the industry, I mean, the comments that Mark made and Natalie as well, as far as, and I'll talk specifically in Phoenix, obviously that's where I am, but you know, again, I think the timing of what's happening is going to depend on a couple of things. One in the process, do we get a vaccine? Which I'm not an expert there, but it seems from all the everybody out there, one will eventually get there, but also how we change the course of how the virus is acting in Phoenix. But, you know, based upon what the dynamics out there, the metrics out there as regards to expected job growth, Phoenix is still projected to have positive job growth in 2021. And the changes that are occurring, as Mark said, people buying homes. I mean, this pandemic is going to change. You know, people are losing their jobs. People are spending down payments that they had saved to live. So, again, I think we're going to start seeing, assuming we get control of the virus, I think we're going to start, by the end of 2021, I think we'll be financially, as far as the strength of the market, we'll be nearing where we were, towards the end of next year, in my opinion.
All right, Mike.
I agree with Chapin. Until we have a vaccine, we're likely to be kind of somewhere in, one of the phases of reopening or closing. And I think it's all driven by that. I think Arizona will be an attractive place for people to come because we don't have huge density issues as other cities do. I agree that home purchases will slow down, but I think you'll still see a migration from other states to Arizona. Aside from the bad press we've had in the last couple of weeks. So again, I think the next 6 months is going to be challenging for all of us, remote working, doing tours virtually, in person, by appointment, amenities open or closed. So I still think, we're in this until we have a vaccine.
Yeah. Well, and that kind of leads us to our next question. So we're working under very different circumstances. None of us thought we would be here in this type of an environment. And like Chapin said, we're working in our slippers, and in my case, yoga pants. But tell us maybe a little bit, and Mike, I'll start with you on this question. Like, what kind of advice are you giving your management teams? How are you helping them manage through this pandemic and keep them motivated and focused on the business?
Yeah, I think what I call it is the year of the property manager. That we haven't been a necessity since 2008 or 9, and so I think you have to treat those people with gold and take care of them. We're wanting them to be sincere and empathetic with the residents, but I think as we guide and give them support and guidance, look, they're not on the front lines, but they're on our front lines of our industry, and reinforce them with take them lunch, reinforce, give them bonuses, just make sure that they know they have our support, take tasks off of them that can be done by someone remotely to just make sure they can focus on the residents that live in our communities. And I think that is, once again, come home that for the last 10 years, we've been in a growth environment, we're raising rents, occupancy's going up, and now we need that group of people just to take care of the residents, bring in the rent as much as possible, but be most importantly empathetic with our residents. But in managing them, we need to be empathetic with them and treat them very well. So,
Chapin.
Yeah, I mean, similarly, I mean, the first thing that we, as far as our on-site staffs, is we really got to provide constant communication to them. Things are changing daily. So what we've really focused on a couple of things as relates to our staffs is communicating with, make sure they have the guidelines and the protocols that allow them to do a lot of things that Mike talked about as far as serving our residents and so forth. I mean, Most of us are only doing emergency maintenance calls. Most of us, our offices are not open. So we need those procedures and policies out there. In addition, one of the values we have at PB Bell is get creative, and our staffs have been doing a great job of being creative on how we're leasing, how are we communicating with the residents, how are we addressing, people that are upset because we're taking half the pool furniture out. So again, as Mike said, we got to support them on that. We also need to motivate them. And one of the things that I do every Friday is I try to send an email out to all our staff members that focuses on, the positive in this world and the positive in lives and things to motivate them, because every day we're bombarding them with messages about protocols and what's happening with the virus. So it's important to make sure that we're also, reminding the staffs of what's positive out there as well, just so we're not focusing only on the negative.
That's good. That's important right now, because we all tend to do that a little bit. Now to maybe kind of drill down a little bit, and Mike, we'll go back to you. Maybe you can tell us a little bit about what COVID, I know this is Arizona in general, but what COVID has done with your portfolio, how your rent receipts are looking, occupancies, new leases, renewals, concessions, or any of that coming into play right now.
Yeah, I'd say on the collection level, the last 3 months, we've been right at 95, 96%. And although we kind of entered April very nervous, we were able to collect, 95. We were happy with that. I think then we shifted to May. And so April, May, and June have all been about 95, 96% collected of the billable rent. So that feels good, but my fear is that's driven by unemployment checks in the boost as well as stimulus money. And when that ends, do we revert back to what we thought was going to happen in April, or is there a new stimulus package? Occupancies are down about 1%, and I'm assuming Natalie would concur that we've seen some slippage on occupancy. And again, is that people, moving home or, probably moving home or moving somewhere to get back to, they lost their job, they couldn't afford it, they were a student, they all went home. So occupancy is that. I'd say new leases, I think, are flat. We're not seeing a big pop in new leases. Renewals, though, I think we're still seeing 2 to 3% because they were probably behind market. We were able to get a little bit of an increase out of them, but again, we're not seeing a lot of new leases. We're seeing good leases, but not what we saw a year ago. And renewals, we're getting about a 2 to 3% lift on rents, and that's only because they were behind market rent when they moved in, and now we're just trying to bring them to market. So that's kind of high level answers.
Yeah. So Chapin, how about at PB Bell?
Yeah, no, similarly. I mean, I have to say, when this whole thing started, I was very nervous about what things were going to shake out, and I've been pleasantly surprised so far. As well with collections and rents, we've maintained, most of the stuff, starting in May, I think we collected 98. We're down a little bit in May to 97%, and we're floating around there that way in June as well. I'm concerned about what's happening in July and August, because a lot of that stimulus that we've been, been counting on is going away. But so far, rent collection has been fine. Occupancies have maintained as well. Our portfolio is 96% occupied, so we haven't seen much downward trend in that. On rent increases, on renewals, we're not pushing those. I mean, just because that's more of philosophy that, we don't want to, increase rents right now on people. So, but we are getting better renewals. I mean, if you look at our normal turnover rate last year, we kind of floated in the low to mid 50% turnover rate, and now we're kind of sitting in the mid 40%. So, a lot of the occupancy is being maintained because people aren't moving. As far as leasing, we've got one lease up right now, and it's doing well. I mean, we're leasing. The holiday week it was down, but we're leasing 5 to 10 units a week at our pro forma rents, and we're giving a concession away. But a lot of that is just a function of when you have a lease up, you just kind of do that. But so far, I agree with Mike. We're pleasantly surprised on the economics that we're seeing out there.
Yeah, I can remember early on when this started in March, and we started having our board town hall calls. I mean, there was a fear that we were going to have 20, 30% non-payments. So I would agree. It has been a pleasant surprise. So maybe to kind of move on and talk about evictions. I know we're in the business of renting, but evictions has been a very hot topic in the industry. And we have the CARES Act moratorium and we have the governor's eviction delay that are both set to expire on June 25th and June 22nd, respectively. So and Mike, I'll go to you on this one. Mike, what do you think is going to happen? Are we going to see a massive spike in evictions? Do you think owners and managers are going to continue to work with their residents?
I think you're going to have a little bit of both. I think the residents that I say that have ghosted us, we've heard nothing from, I think they're going to eviction. And we'll see if the CARES Act gets extended or there's some other, if the governor does something to kind of push that out a little bit based on public pressure not to evict. But I think you'll see evictions spike. I think you'll see us move to evict residents who haven't paid at all. But I think that there'll also be a point in time where people are trying to protect their occupancy. And so if you evict, 5% of your resident, if you start at, 96% occupied and you evict 5%, you're now at 91. And you could maybe capture 1 or 2% of that back by continuing to work with the residents that haven't paid their rent. I think you'll see pressure on the owners and management companies to try to hold that occupancy back. In other states, that are 10 or 15% uncollected, you really want to drive your occupancy to the mid 80s. I guess you could by driving out the non-payers, but I think you'll see a little bit of both, Courtney. I think you'll see us push the ghosters, the non-payers, the no responses out quickly. But I think if there's an intent to pay the rent, I think you'll see us work with those residents to get caught up. That's my perception.
Yeah.
Nathan?
Yeah, we're very similar to that. I mean, we've been fortunate, and again, this is our portfolio, is we've been fortunate that we only have kind of a handful of folks that are taking advantage of that situation. And so we will continue to work with the folks that are working with us. I mean, it's an opportunity, and we put programs out there to help people out. And so the people that will continue to work with us will continue to work with them. But as we're in the same boat, if there's people out there, and fortunately, our portfolio, we only have a handful of those, that people are just taking advantage of that. And we've had, one of our properties, we had somebody move in right when this all started. They haven't paid us any rent, and they're not communicating with it all. So I agree. Some of those evictions are the people that are taking advantage of the situation.
Yeah, I would agree. That's what I've consistently heard from our members, that we have a very small segment of our renters that are ghosting, that have figured out how to essentially work the system to their advantage.
I'm sure I'm sure the press is that's gonna make a blow it up than it is. I mean, that's probably where it's an industry where we're gonna need help from the AMA to make sure we don't look like we're doing something bad, because as an industry, I think we're working hard to help people out.
Yeah, and that's an important point. We actually had a meeting with the governor's staff yesterday to talk about the eviction delay. But unfortunately, there is, from the media's perspective, and it's oftentimes really hard to change it, the media is listening to tenant advocates who are saying we have an eviction crisis and there's going to be an eviction cliff. So we have tried to educate the media and certainly the governor's office that while we will have to deal with the individuals, like Mike said, that have gone dark, we're not going to self-implode our industry. We're going to continue to work with our residents, because we can't go to 20% occupancy, vacancy. So we'll continue to work on that. But yes, we are hoping that the governor does not continue the eviction delay in Arizona, and we're working closely with them to get the right facts out there. But so maybe tell us a little bit about, kind of what your biggest challenge has been during this process. If it's more HR related, if it's managing expectations, if it's dealing with their owners. Mike, I'll start with you.
I think I had a list of SOPs that we've never had to create before. So, normally property managers have binders and a myriad of paper they can always refer to if there's a crisis. And this is one where no one could go back and say, what did we do the last time this occurred? So I'd say the biggest challenge is creating new statements, operating procedures, clearly being prepared with PPE. I'd say cleaning supplies, and just, how did we respond? And I'd say the analogy I'm using is what 9/11 did for security companies in the industry, COVID's going to do for cleaning companies. So this whole protocol, of how do we manage in this environment? How do we clean our communities? How much PPE do you need? How do you make residents wear a face mask? Do you give them a face mask? Do you give leasing prospects a face mask? And so I think there's this whole new environment that we didn't have operating procedures for. And as Chapin said earlier, we could inundate them with communication and protocols and SOPs, but how do we give that communication a proper way without overwhelming our team members on site? But again, this is a whole new ballgame for us, and we were writing it from scratch in late March. So,
writing fast.
Chapin, your thoughts?
Yeah, no, I mean, our first challenge and our number one goal is keeping our people safe. So that's just been a big challenge of, you got people, our staffs that are so dedicated and they want to get in and work, and it's just what do we do to keep them safe? So that's been the biggest challenge. I think that we've done pretty good, but as this virus spreads, it's getting harder and harder. So that's something we have to continue to work on and focus on. But right, it's a fear of the unknown. What's going to happen tomorrow? And as Mike says, it's how do we do? There's no playbook. We're writing it as we go, and what's the right answer? And sometimes it's hard to do. Do you want to? Should you open the office? Should you not open the office? And our first point is how we can get people safe. I have to say that I have been pleasantly surprised about our owners. I mean, all of ours have been very positive. Nobody's pushed back on us. Nobody's called and said, why aren't you opening? Why aren't you, so everybody's been very supportive of that. We keep them communicated. And so as far as the ownership, we've been happy with the way they've done that. But so again, keeping our people safe and writing a new playbook as we move forward.
And I'd say, the compliment to the industry, we've been helping each other out. And, as a lot of things you want to beat your competitor. And there were a lot of cases in this where we were going in uncharted waters. And if we went into it together, we were consistent with, our owners and our team members and, each other. And so I think that's been when you get through a crisis like this, working together with your peers has been helpful. And Courtney, and appreciate what AMA and you have done to kind of bring us together to solve problems together, which is obviously encouraging.
Yeah, it has. Mike, you're absolutely right. It's been so encouraging. All of our regular members really banding together, associate members chipping in to helping out. And it's been very heartwarming. So we'll transition now to some questions. I've got one kind of starting off with Mark. Maybe talk a little bit about kind of what you see going on in the stock market. There was a big spike, and now we're seeing a drop, and we've kind of seen this saw blade, I think was one of the comments you made a while ago, kind of pattern going on.
So kind of went into a free fall momentarily. And what happened is people stepped back and they recognized the fact that the whole country was not going to come to a screeching halt. So we maintained some relative valuation and went back to where people feel it's fairly valued right now. You can tell that there's an underlying element of optimism, because every time we do have a little pullback, it's very quick to make that back up, and it's not staying in this downward slide. Earnings are coming in. Most companies are going to be unaffected by this. You look at my firm. We moved 80,000 employees out of 85 to working at home, and we did it within 30 days. And so, if you're capable of being nimble like that, you're going to survive and your earnings are going to be okay long term. So most companies, again, are going to report decent earnings. We haven't stopped living. We've just got different headlines, and the two gentlemen, touched on this. It's all about the messaging now, right now, starting at the top. And so having a cheerleader up there in whatever you're doing is going to be very important. Number one. Number two is managing expectations. And so the stock market right now is not down a lot. Certain sectors are down. Certain sectors are actually up for the year, believe it or not. And we don't have any inflation, and interest rates are incredibly low. So for those of you that are building apartments right now, the cost of capital is incredibly low, and is going to stay such for a while. We also took out the long-term push where costs are going up dramatically all over the place. People have realized that costs have to be contained to continue forward. So expect volatility in the market. Longer term, people are going to look back on this, and either we're happy that they made the moves they did by being in the market, or they're going to regret that they got out. And out of all my clients, this is my 35th year actually, contrary to the bio you read. 35 years of doing this, I have not had one client on my entire client base get out of the market. That's a factual statement. And talking about the vaccine just for 2 seconds, we're looking at Q1 to Q2, best case scenario for a vaccine, Q1 to Q2 of 2021. And that's coming from the inside, from my chief medical officer and the CEOs of hospitals that I talk to.
Yeah, it seems like forever away right now.
But
it's not very far in the grand scheme of things.
It's 6 to 9 months away.
Yeah.
And but at the same time, you're going to get toward that herd immunity where most people have had it, have been exposed, and never got sick. And that's something the media's not talking about. Right. And they're not going to talk about it because it doesn't sell headlines.
So Natalie, we'll go to you next. You talked a little bit about construction. And I think if I remember from your slides correctly, there was about 15,000 units in the Phoenix metro area and 1,500 in the Tucson area. So those are in the pipeline, but are you seeing a slowdown? What's really happening with construction? Is it going to move along as planned? And maybe Chapin can chime in on this one as well.
So all the indicators we have show that it's going to continue to move along. As planned is a very loose term to use. It's going to be delayed, most definitely. I think how delayed or how long that delay lasts will certainly depend on, all of the same outcomes everyone else has mentioned here. When we get a vaccine, if there is a second wave, you have to keep in mind that coronavirus interrupted the supply flow for a lot of, the steel suppliers, the wood suppliers, in addition to, creating an environment where, people can get sick and they can easily transmit it, and they do work in close contact with one another. So for right now, our position is that we anticipate that construction will continue. I don't think anybody would say that construction is going to come to a screeching halt. Do expect it to slow with delayed delivery overall.
Yeah, no, I agree. I mean, we're all in. We've got 4 projects under construction. We'll start a couple more this year. When we're out there searching for capital, the equity is out there. They're looking for deals. We've seen some banks, but most of the banks we work with are still providing financing, through Empty Builders. I mean, I think Empty Builders builds more product here than any general contractor. And they haven't seen a slowdown in their pipeline as well. Again, I think some of the developers that maybe aren't as skilled and have a little more trouble getting capital, I think you might see some of those projects kind of slow down or get postponed. But most of the developers around the country that are have got the strength to do that, they're going to continue. For the most part. So we'll see some slowdown, but I don't expect a lot.
That's good. That's good. So time for one more question. This is kind of directed to Chapin and Mike. So whoever wants to take it, or if you both want to chime in. But are leasing offices and or amenities with your companies being cleaned more often?
Yes.
Yes.
I'd say I'd probably twice as much as they were in the past, and there's probably a higher level of scrutiny on the method of which they're cleaned and the materials that are being cleaned with. Just so I'd say it's not just take out the trash and put a duster over the desk. It's now more of a deep clean. So yes, the answer, I'm assuming Chapin just said yes to.
Yeah, we've got scheduled cleanings of all those amenities, and there's cleaning products in the amenity areas for the residents to use too, if they so desire.
Yeah. And have you all just in general opened up all of your amenities and leasing offices, or just amenities at this time?
Yeah, we haven't opened a few of our offices have opened, but our clubhouses are closed. Our conference rooms are closed. The primary amenities that we've opened has been the exercise rooms and the pools. But other than that, most of the stuff is really closed.
I'd say it was opened a couple weeks ago, and now it's kind of slid back to more being closed. In the amenities, obviously, pools are open. Gyms are, depending on how they can be kind of, how they can be monitored and cleaned, etc. But I think we're going to ebb and flow the next couple months on that entire topic, Courtney.
Yeah, it might be kind of starts and stops. As the governor said
stops.
yesterday, we're in the yellow zone now, not the green. So with that, Mark, Natalie, Mike, Chapin, thank you guys so much for, again, spending some of your time with us on Friday. We really appreciate it and enjoyed hearing your insight. And thanks again. And we wish you all a great remainder of the day. And for our participants, thanks for logging in.
Thanks
Thanks,
for having
Courtney.
us.
Thanks for
Thank
having
you.
me.
All right. Y'all take
All right.
care.
All right. We'll see you.
Bye-bye.
Thank you.
Everybody, good weekend.
You too.